Good day. Today we take a closer look of what truly drives financial performance in the Philippine food and beverage sector. Our study, the upon analysis of financial performance, a comparative correlational study of Del Monte Philippines Incorporation and industry competitors in the Philippine food and beverage sector, explores how financial ratios shape the growth and resilience of these companies and reveal the performance picture behind these ratios.
Let's begin with a brief overview of the company in our study. First, we have the Del Monte Philippines Incorporation. With 98 years in operation, it's a market leader in pineapple, juices, and sauces. In 2025, they reported 10.2 billion in sales and 54% net income growth, demonstrating their strong ASEAN and global presence and commitment to sustainability. Next, we have this Universal Robina Corporation, which is founded in 1953, operating across Asia. They are known for their brands like C2, Great Taste, Yatos, and LVL, and maintaining competitiveness through product diversity and digital transformation, as well as the regional logistics. And finally, we have the Republic Flour Mills Corporation, which is established in 1957 and has expanded from flour to full food and beverage line. They reported 22 billion in revenue and 1.4 to 1.5 billion in net income, with strong export activity and ASEAN growth.
Our conceptual framework illustrates the relationship between our variables. The independent variables or determinants of financial performance are financial ratios, profit margin, asset turnover, and equity multiplier. These ratios, with their respective indicators like net profit, revenue, net sales, and average total sales, assets, and equity, influences our dependent variable, which is the level of company financial performance, especially measured by return on equity.
Our study is primarily anchored on DuPont analysis, which breaks down return on equity into three components: profit margin indicating profitability, asset turnover reflecting efficiency, and equity multiplier representing financial leverage. We also draw upon supporting theories: Porter's value chain, which links to operational efficiency, particularly profit margin; the resource-based view, which emphasizes the effective use of internal assets correlating with asset turnover; and capital structure theory, specifically Modigliani-Miller, which explores the impact or debt versus equity on the equity multiplier.
Let's define our variables in more detail. Our independent variables are the profit margin. These measures profitability, showing how efficient a company converts sales into profit. Next, we have the asset turnover. This assesses operational efficiency, indicating the revenue generated per peso of assets. And then lastly, we have the equity multiplier. This indicates financial leverage, reflecting the degree of debt versus equity use in financing. Meanwhile, our dependent variable is the return on equity, which is a key indicator of overall financial performance. The ROE reflects how well a company uses equity to generate net income and is influenced by profitability, efficiency, and leverage. These variables within the DuPont system enables us to assess the financial health and shareholder value creation for Del Monte, URC, and RFM.
For our statement of the problem, so this study aims to address several key problems. We sought to: first is the profile of food and beverage companies in terms of assets, liabilities, return, and net income. Second is to determine the financial performance indicators of Del Monte, URC, and RFM in terms of profit margin, which includes net profit and revenue; for asset and turnover, which includes net sales and average total assets; and for equity multiplier, which includes assets and equity. For our third SOP is to determine the individual level of financial performance of Del Monte Philippines, Universal Robina Corporation, and RFM Corporation over the past 10 years in terms of net profit margin, asset turnover, and equity multiplier. Fourth SOP is to determine which among the financial performance indicators significantly predict the financial performance of Del Monte, URC, and RFM as determined through regression analysis. Fifth SOP is to determine the significant relationship between the financial performance indicators and the level of financial performance. Lastly, for our sixth SOP is to determine the significant difference in the return on equity among Del Monte Philippines, Universal Rubino Corporation, and RFM Corporation.
To guide our analysis, we formulated the following hypothesis. For the first hypothesis, there is at least one of the financial performance indicators significantly predicts the financial performance of Del Monte, URC, and RFM as determined through regression analysis. The second hypothesis, there is a significant relationship between the financial performance indicators and the level of financial performance. And the third hypothesis, there is a significant difference in the return on equity among Del Monte Corporation, Universal Rubino Corporation, and the RFM Corporation.
This study holds significant implications for various stakeholders. For the food and beverage companies like the Del Monte, URC, and RFM, it helps identify operational strengths and weaknesses using DuPont analysis, guiding them to improve resource management and sustain financial health. For the investors and analysts, they can gain data-driven insights for investment decision and risk assessment, understanding how financial ratios impact the performance. The academic community and students also can benefit from a real-world application of DuPont and regression analysis within the Philippine context, supporting finance and business education through case-based learning. Finally, for the future researchers and the public, they can use this study as reference for evaluating corporate financial stability using secondary data, enhancing skills in financial analysis and critical thinking.
For our study scope and limitations, so our study had a specific scope and certain limitations. We required a minimum of 10 years of historical data, meaning companies needed to be operationally and financially active for at least that period. We focus exclusively on companies engaged in food and beverage manufacturing with consistent operations in this sector. The study utilized 10 years worth of publicly available consolidated financial statements from 2015 to year 2024 to ensure complete data on income, assets, equity, and other financial metrics for a fair and comparable analysis.
For our methodology, this research employed a quantitative descriptive correlational approach. We analyzed the relationship between profit margin, asset turnover, equity multiplier, and return on equity. The study covered 10 years of data from 2015 to 2024 for RFM, URC, and Del Monte Philippines. For data source and collection, we used secondary data derived from audited financial statements of Del Monte Philippines, URC, and RFM Corporation. We specifically collected data for net profit margin, asset turnover, and equity multiplier from published company reports and records.
Now, let's briefly look at the summary of the financial statements which were the basis for our analysis. So this slide shows the financial data for Del Monte Philippines. Here we have the financial data for Universal Rubino Corporation. And finally, the financial data for RFM Corporation.
We now move on to the descriptive statistics of food and beverage companies. This table presents the descriptive statistics for Del Monte Philippines Incorporation, including assets, liabilities, revenue, net income, and the key financial ratios. Over the past 10 years, Del Monte Philippines Incorporation demonstrated financial stability with consistent profitability, maintaining an average net profit margin of 9.43% and a solid ROE of 22.24% despite modest asset turnover. The company's balanced use of debt and equity, along with effective cost management and financial leverage, reflects resilience and moderate growth within the capital-intensive food and beverage sector.
For the URC, they demonstrated financial stability with strong asset holdings average of 157.9 billion and controlled liabilities of 61.4 billion, supporting its competitive position in the food and beverage industry. While its average ROE is 13.93%, this reflects moderate profitability. Fluctuations in performance suggest the need for more consistent capital management and refined operational strategies to ensure the long-term value creation.
While RFM Corporation had an average profit margin of 7.36%, reflecting consistent profitability and cost control, their asset turnover was 0.0629, which is typically for capital-intensive firms indicating modest asset efficiency. The equity multiplier of 1.51 suggests a balanced use of debt and equity, contributing to a stable financial structure.
Next, we have the descriptive statistics for each of the DuPont ratios. Here are the specific DuPont ratio statistics for Del Monte Philippines. Del Monte Philippines maintained a healthy average net profit margin of 9.43, indicating effective cost control and stable profitability, supported by normally distributed financial data. However, its low asset turnover ratio of 0.0789 highlights inefficiency in asset utilization, while a moderate equity multiplier of 2.77 suggests a balanced yet strategic use of debt to enhance returns.
Next, the DuPont ratio statistics for Universal Robina Corporation are shown here. Universal Robina Corporation demonstrates strong profitability over the past decades with a high average net profit margin of 35.70%. Though it's positively skewed distribution and high kurtosis, this indicates occasional extreme profit years. And despite the URC's low asset turnover of 0.0868 and moderate equity multiplier of 1.62, this suggests that its financial strength is driven more by profit margins than by efficient asset use or aggressive leverage.
And finally, the DuPont ratio statistics for RFM Corporation. Over the past decade, RFM Corporation exhibited stable profitability with an average net profit margin of 7.36%, low asset turnover of 0.0629, and a conservative equity multiplier of 1.5090, which indicates modest asset efficiency and limited reliance on debt. These patterns reflect a risk-averse financial model that aligns with research showing firms with low leverage and consistent margins tend to be more resilient during economic disruptions.
Now let's look at which indicators significantly predict financial performance as determined by our regression analysis. For Del Monte, the regression analysis shows the relationship between the financial indicators and return on equity. While all variables were entered into the model, the ANOVA table indicates a significance of 0.254, suggesting that the overall model is not statistically significant in predicting Del Monte's financial performance based on these specific indicators over the period. Asset turnover shows marginal yet meaningful influence on ROE, providing partial support for the alternative hypothesis and emphasizing the need to improve asset efficiency to boost financial performance in the food and beverage industry.
For Universal Robina Corporation, the model summary shows a very high R-squared of 0.998, indicating that 99.8% of the variance in the ROE can be explained by the independent variables. The ANOVA table shows a significance of 0.00, which is highly significant, confirming that these financial performance indicators are strong predictors of the URC's financial performance. And since all these three financial indicators show statistically significant relationship with the ROE, the null hypothesis is rejected and the alternative is accepted, confirming that the ROE is significantly influenced by at least one of these predictors.
Similarly, for RFM Corporation, the model summary also shows a very high R squared of 0.998, explaining almost all the variance in the ROE. The ANOVA table significance of 0.000 confirms that the financial performance indicators significantly predict RFM's financial performance. The highly significant p-values of net profit margin, asset turnover, and equity multiplier confirms the acceptance of hypothesis number 1, which demonstrates that at least one financial performance indicator significantly predicts overall financial performance.
In addition to that, these correlation tables further elaborate on the relationships between the financial performance indicators and the level of financial performance, which is the ROE. For Del Monte, we observe that it is not statistically significant for both net profit margin and asset turnover in the ROE, since no financial performance indicators show significant correlation with ROE at the 0.05 level. Hypothesis 2 is rejected, suggesting that the external factors like firm size, industry context, or short-term fluctuations may disrupt the expected DuPont relationship.
For Universal Robina Corporation, it shows a strong positive and statistically significant correlation between the net profit margin and the ROE, which is 0.00, and asset turnover and ROE is also 0.00. This indicates that both profitability and asset efficiency strongly contribute to the URC's financial performance. And given the significant relationship between key financial indicators and the ROE, the hypothesis 2 is accepted, confirming that the URC's financial performance is strongly linked to its internal profitability and efficiency, warranting continued focus on these areas for sustained financial health.
RFM Corporation also demonstrates strong positive and statistically significant correlations between net profit margin and ROE with 0.000 and asset turnover and ROE with 0.000, which is statistically significant at the 0.05 level. Given the strong and statistically significant correlations between ROE and both net profit margin and asset turnover, the alternative hypothesis number 2 is accepted, confirming that financial performance is significantly influenced by key profitability and efficiency indicators.
To test hypothesis 3, an ANOVA was conducted and revealed a significant difference in ROE among Del Monte, URC, and RFM. The Levens test, which is P equals 0.007, indicated unequal variances, but both the Welch and Brock-Forsyth tests confirmed the result, validating the presence of statistically significant differences in ROE across the companies.
The Gaines-Howell post-hoc test confirms significant differences in the ROE between Del Monte and RFM, as well as between the URC and RFM, with both a significance level of 0.017, but no significant difference between the Del Monte and URC. These findings support hypothesis 3, highlighting that RFM's ROE significantly differs from other of the two companies.
In conclusion, our study has revealed important insights into the financial performance of these key players in the Philippine food and beverage industry. Based on our findings for Del Monte, we observe a weak profitability, a declining ROE with 1.18% in 2024 and lower profit margins of 6.72% that indicates cost control issues. Second is operational inefficiency, a very low asset turnover with 0.0428 that signals underutilization of resources and inefficiencies in generating revenue. Third is increased financial risk, a high equity multiplier of 4.12 that reflects a rising dependence on debt, amplifying financial vulnerability. Lastly is competitive pressure. Del Monte's underperformance compared to RFM and qualitative lag behind URC underscores the need for urgent strategic action.
Therefore, Del Monte must reassess its financial and operational strategies to reverse its downward trend in ROE. Priority areas include improving internal efficiency, and asset utilization, strengthening profit margins through better cost management, and reducing over-reliance on debt to ensure long-term stability. By addressing these core issues, Del Monte can regain financial resilience, enhance investor confidence, and secure a competitive edge in the evolving food and beverage industry.
Now for our recommendations to improve Del Monte's return on equity, we recommend first is to enhance asset utilization. This involves improving inventory management, streamlining operations, and investing in technology to increase revenue generated per asset. Next is to improve the net profit margin, which is to focus on strengthening cost control, regenerating supplier terms, and optimizing the supply chain to boost overall profitability. And lastly is to manage financial leverage. This is to rebalance the capital structure by reducing debt reliance and using leverage only for high return investments.
Additionally, Del Monte should optimize working capital, improve receivables collection, extend payables where possible, and adopt just-in-time inventory to enhance liquidity. And lastly, invest in innovation and growth. Expand product lines, enter new markets, and modernize production to drive long-term revenue and competitiveness. By comprehensively addressing these core areas, Del Monte can effectively reverse its declining ROE, significantly improve its financial health, and achieve sustainable growth with a stronger market position in the dynamic food and beverage industry.
Financial performance isn't just a result, it's a direction.
Our findings reveals that behind every strong company is a financial strategy rooted in precision, balance, and adaptability.
In a world where numbers tell powerful stories, those who understand them shape the future.
Thank you for your time and interest in this presentation. We hope our insights sparked meaningful discussions and informed decisions. Daghang salamat!